All right, all the formalities are out of the way. Let's bring George back on the show. George, welcome back to the Daily List Report.
Hi, Randy. It is great to be here with you today, as always.
As always, thank you, George, for your time and for sharing all of this knowledge with our amazing agentpreneurs across the country. Today, we're going to talk a little bit about rents. So, what's going on with rents and broadly the rental market? And then we're going to get into what it portends for the housing market because it's a really interesting connection between the two.
Absolutely, Randy. And the truth is, the rental market has had just an unusual trajectory over the last year as the broader housing market and the economy. Let's consider, first of all, that with the lockdown last year and the quarantines, right, when business activity shut down, restaurants closed, pretty much everything came to a standstill. Many folks who lost their jobs during the period, and if you may remember, during April of last year, over 20 million Americans lost their jobs in 1 month, a tremendous blow. Many of those folks were at tremendous risk of losing their housing. So the government stepped in, put a tenant eviction moratorium in place, and that had to be renewed. We saw a renewal in September when the initial expired, then we saw another one in December, and now we have a new one until June of this year. So with that, on one hand, we basically provided safety for tenants. On the other hand, however, the market has been very challenged. Why? Because for tenants, many of them are still drawing unemployment and are behind on payments on their rents. For landlords, for practically 6 months of the year, there was not a clear resolution on how they were to deal with their own lender, who was basically lending them for their property. For Fannie and Freddie loans, the GSEs in a way provided some relief, saying work with your lender so that you can get an extension or some way to modify the loan. But the pressures have been there in the system throughout this period, and they haven't necessarily gone away. The latest fiscal stimulus provided some funds for many landlords, so we'll see how that fares. But by and large, I say this only to basically underscore how challenging over time has been for the market. When we look at the actual rents, our data showed that for February, rents were up 0.6% compared to a year ago, so prior to the pandemic, averaging a little over $1,400 per month across the top 50 metros. But beside that national picture, what we have is a very nuanced market. Large, high-density coastal downtowns, which have been sort of the happening and hot places for the last decade, are struggling with high vacancies and declining rents, whether it's San Francisco, New York, Boston, Washington, D.C., they're seeing rents decline by double digits.
Yeah.
Meanwhile, a lot of suburban markets within commuting distance or some markets that are much more affordable have seen rents actually rise. Here in February, the strongest growth in terms of rents we saw in New Orleans, Sacramento, Modesto, Riverside, and Memphis. So markets which are characterized by solid economic growth, but much better affordability. So we've seen renters, in a sense, move much quicker towards affordability this last month, and I expect that trend to continue into this year.
We've seen some of that migration that we've talked about, multiple times, right, on this show, George. And so, what is that? What is the result of that been for, let's just say, landlords, let's say owners, right? Not the big owners, but like the moms and pops or a lot of the agents who are watching right now own properties. I'm fortunate enough to own a couple rental properties myself. And so we're wondering, well, what does all of this mean for us?
That's an important question, Randy, and I'm glad you brought it up because, to your point, when we look at data for some of the large corporate entities that manage big properties, the payment rate has been fairly steady, well above 80% across the country. So yes, they have felt some pressure from the unemployment situation, but not nearly to the same extent as, to your point, individual investors for whom maybe the one property they have for rent, if the tenant can't pay, that's 100% in a sense lost revenue
Yes.
over a long enough period of time. So whereas lenders might have willingly postponed that repayment or modify the terms to lengthen to make up for that over time, it's clear that that period is likely to come towards an end by midsummer. So on one hand, I'd say it's good that we're moving towards some sort of resolution. On the other hand, it is also become clear that for many high density locations, the number of tenants who are likely to come back may be much smaller than expected. And what's that doing? Well, it's putting a lot of demand pressures in suburban markets. It's putting demand pressures in the single family housing space. Why? Because for many folks who don't want to live in a crowded city, and just as importantly, for a lot of millennials who have now grown families, have children, that one bedroom condo downtown is or apartment is no longer as big of an alternative. They are naturally looking towards the suburbs, where most product tends to be the single family townhouse residential. And so what I see in this market as a result of these changes in the rental sector for this past year, I see a lot more investor interest into the residential rental space, which creates a really interesting dynamic. So not only are we seeing a market in which first-time buyers, move-up buyers, retirees are looking to purchase their next home, but so are big asset managers, so are big investors, along with small investors, all vying for similar properties.
This has always created some pressure in that kind of median priced home, right? I mean, those are the prime homes that are bought up by the big firms and the big funds, right? So there's always been that pressure, but now, given this migration, it sounds like there's additional pressure there. So that creates a real challenge for inventory in sort of the starter-ish or single-family home in the suburban market.
It certainly does. I mean, let's consider the fact that prior to the last Great Recession, 2008-09, the single family rental property was not anywhere near the radar of institutional investors. It was not something they would touch. It was too diversified, too hard to maintain and keep track of. However, you remember probably very well 2009, 2010, during the downturn, when large investment hedge funds really stepped into the market and bought properties at foreclosure by not just by the hundreds and thousands, by the tens of thousands.
Yeah.
Subsequently, they turned those rental incomes, securitized them, and basically what they did, they validated that the single family rental model not only works, but it's realistically now becoming its own asset class, similar to how some other commercial real estate properties are valued, whether it's office, retail, self-storage, industrial, and so on. Many investors are beginning to look at the single family rental as an investment class, even though it's not officially tagged as such, to the point where now we have single family communities that are basically built from the ground up purposefully for rental. So absolutely, to your point, this is creating a challenging environment in the in what's normally the affordable segment of the market, right? Because that's where most people are going to look for housing. And that's where investors are also targeting. So to your point, given how tight of an environment we are from the supply standpoint, the fact that now we have first-time buyers, and a lot of them, right? Millennial generation is huge. We have almost 5 million of them turning 30 every year for the next 4 to 5 years. In addition, you have the move-up buyers, and then you throw in obviously investors into the mix, and it creates a tremendous amount of pressure. And I don't yet see the volume of new construction addressing all these competing demands.
That was a great overview. I appreciate that. We haven't really spent time talking about this segment of the market specifically or in this level of detail on the rental side, but I think it's a really great update. I mean, depending on who you are watching, right, opportunities abound, right? There's certainly some challenges here, but there's a lot of potential opportunities in some of the stuff that we talked about today, George. Thank you so much for coming back on and giving this update. Really appreciate it.
Absolutely, Randy. Always a joy chatting with you and staying abreast of latest developments, for your agents.
Well, there you have it. Another great update from George, this time on the rental market. There's, I'm going to make this point to all of you again watching, right? I love having George on because, he makes this information accessible, but these things are important and some of them are complicated concepts. And he and I have gone into depth on the connection between X and Y and A and B and all of that, because these are the underpinnings of this industry. And the more, at least in my opinion, I'm sure George would share this, the more you understand these fundamentals and how they impact the market, the better an agent you're going to be, the better decisions you're going to make, the better you're going to be able to serve your customers, the better you're going to be able to make your own financial decisions as you plan for your own future. So this stuff is really important. Appreciate you watching, and we'll see you again real soon. Bye.